Looks like a lot of you all are customers of Doorvest. So hey again, welcome. And for those of you who are new here or don't know much about Doorvest, I'll kick it off and introduce myself really quickly. My name is Kristina and I'm a marketing lead here at Doorvest. Doorvest is a modern way to build wealth from anywhere. And our mission is to advance financial security for all through real estate investing. So we do this through helping individuals source, renovate, and operate their rental homes entirely online. So with tax season upon us, we wanted to introduce and welcome Tony Hoong here, who'll be sharing and educating us about tax advantages of real estate investing, and then closing out with the live Q&A. So if you have questions, definitely wait till the end and we'll be sure to answer them. So Tony is a CPA, in other words, a certified public accountant. He's the founder of the CPA Dude based in California. His goal is to simplify taxes and really communicate the tax implications for each client's specific needs. He stems from KPMG's tax and state department, and then also has experience from Uber and Doordash's corporate tax departments. So without further ado, I'll kick it over to Tony to take it away.
All right. Thank you very much. Yeah. Welcome everyone. So today we'll just talk about some kind of like common tax items that we always see and answer, and also kind of just like steer, all our clients towards, and anyone that has questions to make sure that you're really taking advantage of the tax code by investing in real estate. So there's always, the tax code's written a certain way. And obviously, real estate is one of the most tax advantaged ways to not pay income tax on the income that you truly earn. So prepared a little deck for everyone today. We'll go ahead and walk through that. So I'll share my screen here. All right, can everyone see my screen okay on here? Okay, cool beans, cool beans. So yeah, just a little a presentation for everyone here today. Just before we dive into it, just want to just note, more so just discussion points today, just kind of from an education standpoint for you to be more aware of, not tax advice for everyone here. So do please, contact your own CPA or your own preparer just to make sure that what we've discussed today aligns with, what they can do for you. If you need further assistance too, or you have more questions, we'd be happy to help you guys out too. So just want to caveat that for you here, just kind of discussion items for everyone today. So yeah, we'll just talk about common questions that we get. Also a little bit from a tax filing tip perspective, if you're freshly new into real estate investing and Doorvest was like your proxy to get into it, some things that you should look out for, or at least tell your CPA what to look out for to make sure that you're taking advantage of everything that's presented with you. So now that you've gotten dealt a nice hand of cards, how to make the best use of it. So, first, four main items that we'll go into here. So just the tax benefits of real estate. So, the biggest one is more so just generally you don't pay income tax on the earnings that you have. So through non-cash losses, just like your depreciation, all that income will be shielded from income tax. So say, for example, you're generating rent of, $8,000, then you have, management costs, some repairs, and then you factor in depreciation. Generally, all rentals that do have a mortgage generally will result in like a zero or a loss on paper, but you truly do have money in your pocket. So it's not like you actually lost money. So that's like the biggest item for a tax savings wise. It's like you're making money but not paying income tax on it. So that's one of like the best benefits of like tapping in and really getting a deal. So that's kind of like one area why we advise it. As you grow the portfolio too, just not from a tax wise, but just from true passive income, you're generating passive income streams. So those are a couple items to start off with from tax benefits. And then you can really get really involved into it. So just as, a passive investor, that's one way you can get just through buy, hold, long-term rentals, short-term rentals, even from a house hack perspective. So say if you're going in and you're purchasing a unit and you're going to decide to live in one of the rooms, there's, one way that you can actually start shoving more things towards. So you have one room and say it's total 5 rooms, right? Only 20% of your use is not going to be tax benefit. The other 80% would be a tax benefit. So in that case here, you can go ahead and write off 80% of your other expenses that you wouldn't normally be able to. So for example, your house hacking and you have internet, right? As basic as that, right? Normally you wouldn't be able to write that off, but now you have a proxy to write off 80% of the cost, just because you're renting out the other 4 rooms in this hypothetical. So it's really another nice way to double dip, kind of like your personal life, like, because the whole point of it too is like how much of the like of your personal lifestyle can you write off, right? It's everything. If you have an effective rate between federal and state, hypothetically maybe 30%. I mean, that's a 30% deduction, 30% off on everything that you're buying. So now your internet is 30% off, right? All your utilities, electricity, trash, all that fun stuff is 30% off. So that's another way from a tax benefit to go ahead and double dip into your lifestyle. So that's kind of just a couple of benefits that we just want to outline quick. And then passive activity losses. So this kind of in like layman's terms, I should have explained it to someone today earlier. I kind of like went over like, hey, what's this all mean? And then there was like, what do you mean? So simply put is that if you have a main job, you work W-2 or you have a business, but then you have real estate on the side, if you make more than $150,000, those losses will be capped. So that's your passive activity losses. So it's capped until you can unlock them into a future year. So simply put then is that if you make less than $150,000, then you'll be able to deduct the loss that you put on paper here through depreciation. So that's one way too, as you're kind of growing your portfolio, your income, is to take advantage of that. So that's a really good big piece there. Well, it's better deployed in lower cost of living areas, higher cost of living areas. It doesn't make sense just because of just how much more income you need. And that $150,000 mark is it's a tricky threshold to hit. There are other ways around the passive activity losses. I sometimes just joke to go get married and have that person just only do real estate. So there's the real estate professional status that you can claim. And then that completely unlocks the door for the passive activity losses. You're no longer going to be subject to that $150,000 of threshold because one person here has their real estate professional status. And because of that, they can take all these losses that you're generating from the rentals to offset the normal income. So there's a lot of structures where I have with some clients where, someone's in tech, has a stable job there, and then the other spouse just gets into real estate. And then that way the spouse unlocks the real estate professional status. They generate $10,000, $20,000, $30,000 of losses on their Schedule E's, the rentals, and it offsets that W-2 income that the other spouse has. So that way you're actually getting a tax benefit and you're playing to the code. So it's more so using real estate, using businesses, like how can you really benefit from the tax code? It's written a certain way. You just got to play by the book of like how to best use it. So that's passive activity losses to go over that point. The next part would just be, a common question is just like, do I need an LLC and a trust? And it's a very wishy-washy answer. And you always want to kind of go back, think about how much do you have to lose in the property. So say if you bought $1 million home and you did 3.5% down, right? You don't have that much to lose at stake versus the complete opposite. $1 million home, you went straight cash. You have $1 million of equity in home. So see how much equity you have in a home. And then that could determine if you have an LLC to have and a trust to protect your asset. So for example, and it's also dependent on your threshold of risk. So example, you have $100,000 of equity in a home. To some people, that may be a lot of money and they can't ever risk to lose that money. Otherwise, they'd be plummeted. While some other people, they were like, oh, 100,000, I suppose I could lose it and I'll be fine in the next 5 years or so. They can actually stomach that risk. Then, it's a different answer from person A to person B. So it's like, how much can you lose on equity to that home? So if like everything went to crap and you got sued, they wanted everything, almost like it was similar to the, if anyone's in the Bay, the Oakland fire. Like that whole family lost everything because of it wasn't protected correctly. So that's why you may need an LLC and a trust to protect your assets here. You just don't want them to come after your personal assets. So that's the home itself that can take into consideration, but also outside the home's equity, think about your personal savings accounts, all your retirement accounts, your personal home, your car. Like how much equity do you have there to lose? So the more that you have to lose, the better, the most, better answer, most likely is an LLC for you and a trust to protect your own personal assets. There are other strategies where I see where they just go ahead and get umbrella insurance also. So that's another method too of like, okay, once again, how much do we have to lose? Okay, cool. Let's get the normal insurance with the umbrella policy. That's way to go around it. So those are two ways for you to kind of know if like, hey, do I need an LLC or trust? Another item is like if you're going to go invest with some friends. So say if you just got a good coworker or a good buddy from college or high school, it'd be best to kind of form that up just so you have the right operating agreements, have it all taken care of, like just in case something were to ever go astray. All that's documented there. So those are probably like a few scenarios of when you would want an LLC and a trust. It's more so to protect the assets. One common misconception from just if you're doing long-term rentals or short-term rentals of like, hey, does an LLC save on taxes? It doesn't. So from a tax perspective, it doesn't do you anything. It only just helps you from a legal front. Only times when you're going to save on a tax perspective is if you're going to be in a corporation, whether it's S or C corps. So that's a whole nother story for if you want to get in property management, flips, it's a whole different arena within the real estate world. So that's kind of just to answer the LLC and trust question. And then the last common question to kind of walk over today is just what if you own the home jointly, but you don't actually, you're not married. So common cases like, all right, cool. Like boyfriend, girlfriend, both buy the home. What do we do? How do you report the home? And the rule for the IRS is that whoever pays the benefit gets to take the deduction. So that's how you would want to lean it out. That's, what they say. But sometimes I see it where people go ahead and, one person takes all of it because they may be in a higher income compared to the other person. So that's another way to kind of like shift the tax liabilities and the burdens around to see what's the best way to maximize it. So that's one thing from the joint home perspective. Also, even if you do it from a friend's perspective, once again, say you don't have an LLC to shoot out a K1 and you guys just bought it in personal names, what's the best way to divvy this up? You want to make sure if you're using two different accountants to make sure you report the same numbers. So example is that, one person, the mortgage interest, right? Not both parties can take it. Either one party takes, you have to split it out. So the pie's $100, right? You got to split out 50-50, 40-60, 30-70, whatever you call it. You don't want both parties to take the $100. I've seen that a lot. So just making sure, otherwise this just triggers weird, good old notices and audits. So just avoid that, be on the same page, try to say, just use the same person, then they will know. So that's from a joint home, but nothing on paper through, either a marriage or nothing through an LLC on an operating agreement. So some common questions there that we get and just wanted to address for the crowd today. And then kind of just some tax filing tips. So whether you have a CPA or if you're kind of doing this DIY yourself on TurboTax, these will just all help for you. And also just to keep items going throughout the year, because the biggest hurdle for most people is that getting the data, getting the information is difficult. But I mean, when you have like, nice companies like Doorvest here preparing nice total rents received, total repairs, all that for you on a silver platter, it's good. So on that item, there's the income statement. That's more or less to understand how your property is doing from a month-to-month basis. There's also going to be basis that I want to talk about. Basis is just, how much is the property worth on the books for the IRS purposes. And then lastly, too, is just commonly missed deductions when you're doing your taxes when you have a new home. So the first on the left-hand side here, this is just an income statement, more so kind of preparing it to feed into your Schedule E on your tax return. And, it's very straightforward. It's just your revenue top for the whole year, your operating expenses throughout the whole year. These are just some categories that I listed on here, just in case they can kind of like give everyone just a reminder of like, making sure you take your ads. Did you go visit the property? It's always kind of like write that off the first year, cleaning, maintenance, commissions that you paid, legal and professional fees. Did you get LLCs drafted up that year? Did you have, generally, this is where my fees are written off to. So that's an area to have a CPA prepare your taxes. Mortgage interest, any type of management fees that you paid, and then just utilities. Sometimes there's taxes and licenses. So sometimes some cities require you to have a business license within that city. It's all dependent on there. So you want to check your municipal code for where you operate. And then some other items, software. So if you're using any paid software to, manage or just keep tune or anything, or if you have security cameras and you want internet also just to like view all that. So those are some items from an income statement side. So that's, fairly straightforward here, just something to keep track of. I would do this just to have a gauge on this, at least once every quarter, just before, or you get through the whole year and then you're scrambling for 12 months on that. So that's the income statement side, and it all feeds into your tax return. And now this one on the right-hand side is that cost basis. And the whole point of this, it's tedious, don't get me wrong, it's not fun, but start up a Google sheet or some sheet or Excel that you can always refer to, and then track all your expenses. The reason why I say this for everyone who invests in real estate, even if this is your primary residence, it's not even a rental unit, do it for any property that you have, because when you go sell the property at that one day in time, when it's just a matter of time till you sell it, you need to figure out how much is that property worth, because that will offset the tax basis. So for example, you bought the home for $500,000, new roof for 50, cabinets for 20, counters for 20, floors for 10, and then so we're up to 600,000, and then windows another 20,000. So now adding all of these up, it's $620,000 is your tax basis. So when you go sell the home for $1 million, you'll just have that 380 gain. So the $1 million minus the 620, versus if you didn't track any of this, the roof, cabinets, counters, floors, windows, you spent $120,000 in our hypothetical, but for all you know is that you only have $500,000 for the home that you already bought it for. So now you're missing out on $120,000 of tax deductions, and on an effective rate of 30% on a hypothetical, 30% on 120, that's 36 grand you just left off the table. So just keep this every time you make any major improvement to the home, major being if you were to remove it from the home, would it affect the use? So for example, curtains, you can remove it, it won't damage or hurt the home and the functionality. Windows, though, if you remove it, that kind of goes a lot piece of the home. So this is why basis is important. And then also you have depreciation to chat about in the future also. So that's cost basis for us. And then just the last tip here that we have is to go over the commonly missed deductions here. So unless like your CPA is like in tune with real estate and knows what to look for, or if you're doing this yourself, this isn't a tax document. It's just your closing disclosure. And highlighted here is your prepaid interest and your property taxes that you paid at close. So these two items here, for in this hypothetical here, you almost lost, if you didn't find it, you lost $1,000 of deductions. So just want to make sure you go back to your closing doc for the first year that you have the unit and making sure that you cover all of this. So those prepaids, oh, I should highlight this one actually down here. You have property taxes too. So all these items add into the tax return, and you just don't want to leave it off the board. You pay for it, so you have all the right in the world to write it off, but it's commonly missed if you don't know where to look. So that's the closing disclosure, missed tips there. And yeah, those were just some quick items that we just wanted to go over today in terms of common questions, tax filings, and then yeah, be happy to dig into the Q&A here.
Yep. Thank you so much. Love the tip at the end. I think, going back to your settlement or your closing statements is going to be crucial for a lot of us who recently bought a home. So I think there was a question earlier from Amar Paul. It was about, does LLC really protect given the piercing?
Oh yeah, so piercing the corporate veil. So you do want to, before you kind of want to invest into a unit, you definitely want to structure this up correctly with your attorney. So making sure that the transfer of funds was in the LLC to start with, and you're not just commingling. So generally what we see is that, okay, cool, bought it, and then it is deed it and title it over. At that point, the waters are muddied already. So yeah, it is, not the greatest and cleanest way. If you're doing it like textbook definition wise, start up LLC, fund it properly, and then go purchase.
Awesome. Another question we had was about partners partnering on a few rentals. Currently, they have them both in an LLC, and they heard that they don't have to worry about the 3/15 deadline for the form 1065. Is this true? I'd like to hear from you.
Oh yeah, so it would generally I would drive this from how the EIN SS4 form was filed. So on that form itself, it'll tell you what form you need to file. So the 1065 partnership tax return, that is due March 15th, which is right around the corner. And that would then that would drive your requirement. However, I think the question is kind of getting at, like, if it's, if you're so that's if you're two separate unrelated parties, yes, it's a partnership regardless. So you need to file 1065. However, if you're a married couple though, husband, wife, then they're disregarded for federal purposes. So what that simply means is that the IRS sees you as like one unit. So then that way you're not subject to filing a partnership tax return. And then you would just file this on your personal 1040 return, which is due 4/18 this year. A couple extra federal holidays changed it from 4/15 to 4/18.
Cool. So it looks like we have some popping up here. Can expense be sorry, let me revise this. It sounds like they're asking if we can roll over expenses. So maybe if it happens in 2021, can we roll that over in 2022?
Oh yeah. So the expenses, yeah, generally you do want to take expenses in the year that, the property was kind of put in service. Just so say if you bought the property in December, you didn't really get it ready until January, then it'd probably be advisable just to get all those expenses lumped into the year that you're actually generating and using the property. So that way, yeah, you can roll over those expenses. Also, another item of speaking of rollovers is that you can go ahead and speaking on the passive activity losses earlier too, whatever you don't use in the current year, it rolls over every year until you have passive income to offset it. So it's just going to be pooling up a massive bank of losses. So on the day that, once, say if it pays off, you won't have that much of an expense anymore, then it can start to offset all that. So definitely from carry forwards, rollovers.
Cool. And then from Paul again, if it's a joint purchase with friends, but not an LLC, how would you split the tax?
Yeah, so joint purchase with friends, not an LLC. Let's see. Okay, so you're not LLC, so you're not going to report on 1065. So, okay, so it's going to be on 1040. So yeah, on that side, depending on the split 50-50, it'd probably be easiest if you did 50-50 or equitable share like percentages. And then the tax, generally it should have zero tax implications anyways, just because of depreciation sends everything below zero. But say if it did generate cash, then if you're splitting each portion already fairly, then you'll like each person will pay their own fair portion. So for example, you got 3 people, you got the unit at 12 grand of revenue. And then you would just say, and then 4 grand each goes to the 3 people, and we had no expenses, then each person would just pay the 4 grand on their own income tax return, or the tax due on the 4 grand.
Awesome. Okay. Sounds like we have more questions about LLC setup. So is it wiser to use one LLC for your properties, or should you have an LLC for each individual property?
Oh yeah, this goes back to just your appetite of risk. So appetite of risk and managing costs. So if you're super risk adverse, one LLC per property is one like the safest way that you can go. You can't get any more safe than that. But it doesn't work as well once you're in a state like California, where every LLC is $800 each year just to maintain. So, and then you have a separate tax filing for it also. So it really depends on where you're sitting at, how much you're willing to spend on it. But from legal protection wise, yeah, it would get you pretty bulletproof from there. So then if one falls, it doesn't affect all the other ones. Unlike if you had all the properties in one LLC, then they can come after the assets of that one LLC with multiple properties.
Cool. Yeah, it looks like it kind of goes back to your risk appetite and things like that. So yeah, really evaluate what that looks like for you all. Somebody wants to hear more about umbrella insurance and LLC. If you can add maybe a couple more lines there on the differences or the benefits of each.
Oh yeah, so a little bit more. Okay, so you have an LLC, so you have protection there, and then you have insurance to cover, say if someone slips and falls, and then the umbrella just goes further more for extra protection, just in case the normal insurance doesn't cover. So that's kind of using umbrellas. I can't remember if it's 250,000 or 500,000 per umbrella that you can have. So yeah, that's like, because at one point in time where say if the units are past those amounts and it can't even insure, if you have a paid off unit that's worth, beyond the insurance policy, then the LLC will really kind of be where you want to be. And then also the other way too is like if you don't have an LLC and you want to limit your liabilities, is that have general insurance, and then you have the umbrella again. And if that umbrella goes up to 500 or 750, whatever the hypothetical, like the number is that it covers, the coverage on it, then that way they can come after that much money that the insurance company is willing to pay. However, once it goes that point, then you're kind of like, and then come after personal assets if it's not in an LLC.
Okay. Can you please elaborate on the tax deduction for an investment property depreciation?
Yeah, so on the depreciation, so let's see here. If we take a simple like example, so you have an investment unit, and say you $1 million, you paid 25% down, so you got $250,000 into the unit, and then that's not your depreciable basis. So what you have to do is take that million of the property, see how much of it's land versus how much of it's building, because land's not depreciable. And then let me just fire up a calculator here. So if you had, so say generally the rule is 25% of the basis is land. So in our example here, I'm going to throw it on the screen here. So you got $1 million.
Yeah, maybe for since a lot of these rental homes average are around like 200,000, maybe you can use that as a.
Oh yeah, let's do 200. Yep. So let's do 200,000. And then let's do 200 grand. And then let's go 75% of it's actual building. The other 25% is land. So land can't depreciate. So times 0.75. So yeah, 150 grand is your depreciable basis. Now, 27.5 years is how much you can deduct each year. So this way you're generating, 5.45K of non-cash expense. So you get this because you bought that unit. And this is kind of like, you're more or less playing with leverage from a tax side. So you get this, you paid, let's see here, 200,000, 20% down. So 40K. So you paid 40K and you get this benefit, a tax asset of 175K in there, 150K here. So 5.4K is depreciation that you can offset against all the rent that you have. So if your rent, say, what's the average rent, I'd say, on a 200 grand home right now in these markets?
Yeah, let's say about 1,500.
Okay, 1,500. So 1,500 and then times 12 on there, and then minus the 545. I think it was about 5.45K, I said. So now that brings down your taxable income to 12,550. And then the rest is just going to be, say, interest on that. So interest on a 150K times what, 4%. So 12,550, that's the number to remember. So $6,000 of interest. So now you shave down your bill down to $6,000. And now you only have to have $6,000. And then you have property management, you got utilities to cover, and then utilities management, and then any other expenses that you may have. So, because if you didn't have depreciation, you would have that 5450, and then you have the times by your tax rate. Say your tax rate's 30% between federal and state. It's a $1,600 tax benefit you get for taking depreciation.
Wow. Thank you.
Yeah, yeah, so that's where the juice is for a lot of the depreciation. Yeah, it's a little bit complicated, and there's faster ways to kind of take it. So there's cost segregations where you have an engineer and a CPA come out and they see, instead of that 27.5 year basis, that the denominator that I put out, they'll classify items in the 5 year, 7 year, 27.5 years. So then you can front load it way faster and get a further tax benefit. So then generally from a tax strategy wise is that since you're paying less tax because you're using all these strategies and playing to the tax code, now you have more money to get the second unit, and it just keeps snowballing because you're playing to the tax code now.
Okay. Along those same lines, what happens if we buy a 27.5-year-old home? Can we still deduct depreciation still for the next 27 years for the home?
Oh yeah. So yeah, I think, yeah, so it doesn't matter how old the home is. So it could be new construction if you wanted to, new construction or like an old Victorian. Doesn't matter when the home was built. No matter what, you'll always, because in the IRS eyes, residential real estate is always going to be 27.5 years.
Cool. So no matter what, if it's an older home or a new construction, you can still take depreciation on a yearly basis.
Yep. Mm-hmm.
Sounds good. Cool. So we're closing out a little bit here. We have a question more on the property. So this person is new to property investing. They're wondering what they should look out for in a CPA to make sure that, she's getting the best and accurate deductions for her investment properties.
In terms of CPA wise, I would just first ask them, are they familiar with rentals, Schedule E's, to make sure, one, that's where they're sitting at. And then otherwise they may not know what to do versus like, because a lot of the tax preparers, EA, CPAs, like, they can just take in the data and then just put it on return and call it a day. So C1, are they familiar with Schedule E's? Have they done rentals before? Another one too is out of state rentals. So if you're investing in a state that you don't actually live in, make sure that they're versed in that state's taxes. So that's another thing that they may miss too, and they may not allocate, and then you're paying double tax. So those are a couple items just to see, like, out of state experience if you have a rental out of state, and then 2, are they familiar with Schedule E's and rental properties? And more so, like, do they have like a nice template structure for you to feed them the data? Are there any follow-up questions on there versus just, hey, give me your docs and here's your return? That's probably not where you want to be.
Cool. Thanks so much for that question and closing out there. So yeah, I think it looks like we're out of questions. Oh, looks like we have one last one coming in. Okay, cool. I invest in both rentals and crypto. What's the best way to schedule a meeting with you?
Oh, just send me an email. Just Tony at TheCPADude. So yeah, feel free to send us an email. There's a contact form on our website too. But yeah, it's crypto's another one of the areas that we've been kind of like really working on a whole bunch of different strategies for, since the code is actually very gray on that space. There's a lot of opportunities that you can take that I don't know, some other CPAs that wouldn't be willing to bat on it. We just get a little bit more aggressive with our tax positions as long as we can substantiate it, just to help our clients save more money.
Sounds good. Cool. Well, we're gonna close out today. I think that is a great way for us to kind of, again, just kind of close it out. Taxes are super nuanced, and as you can tell, there's a lot of different questions here and there. So again, highly encourage you all to seek out additional advice, whether it's through the CPA Dude, Tony, through their communications channels. And I'll wrap this up and send over his contact, his website, and everything there. And again, appreciate the time that everybody took to join in today, asking Tony all the questions. Thanks again, Tony, for taking the time today. Really appreciate you sharing all the knowledge and answering all the questions.
Oh yeah, no, thanks for having us.
All right, cool. Well, thanks everybody. We're gonna wrap up. Thanks again for joining.
All right.
Bye.
Yeah, bye-bye.